A quick explanation of these allocation terms is probably needed. There's a ton of information on this stuff on the web, so feel free to check out a site like investopedia.com if you want more information. But here are the basics. Large cap domestic are stocks of big companies located here in the USA. Their market cap is over $5 billion. That's a fancy way of saying that these are big, giant companies. These are also typically very stable companies. Their stocks don't skyrocket per se, but they also don't typically crash. Compared to smaller companies, they may not grow as fast, but to offset that, some of them pay dividends to shareholders. They give you money just for owning them. You want some of these in your portfolio because they're stable and growing over time, just like you hope your portfolio will do. Mid-cap companies are less stable than large cap, but more so than small cap. Some years, mid-caps outperform large and vice versa. That's why it's a good idea to own some of both. You don't have to have a specific mid-cap bucket in your portfolio. You can add this bucket to your portfolio later if you're just starting out now, but I think they're good to have. Small cap companies are less stable, and in fact, they could go out of business. But they could also be a great idea that's just catching on and set to explode. Owning these adds a little spice to your portfolio, as this is where some of the real growth is. Being smaller, however, means that some of them can actually go out of business. So small caps are more volatile than large caps. That means they can have wild mood swings, up a lot, but down a lot as well. The international bucket is filled with international companies. It's a global economy out there, and some of the best companies are not here on US soil. Owning some international companies also helps with diversification. And not having all your eggs in the domestic basket helps when things in Europe are just peachy and things in the US are tough. It's great to be a proud American, but don't think that investing overseas means that you're anti-US. What's more American than doing your best to succeed? You need to use all the tools at your disposal. Emerging markets are also international in nature, but are from developing economies. Vietnam instead of Germany, for example. These are even more volatile than US small caps, but worth a place in your portfolio for the potential they offer. And lastly, cash and bonds are an extremely important bucket to have in your portfolio. Bonds are the safest investment vehicles you can own apart from cash. And like a dividend-paying stock, they pay you money just for owning them. They provide income, typically once a month. Cash is important as you always want to have it around for emergencies and in case the market goes down. As everyone was reminded in 2008, the stock market can go down and go down a lot. I'll talk later about timing the market, but for now, always remember that it's a very good idea to keep at least 6 months of expenses in cash. You can keep your cash in the bank or put it in a money market fund, whichever allows you to collect more interest. So here's an example asset allocation that a young-ish person might have. I'm talking about a person, married or otherwise, in their 30s that has a few assets, not a ton of debt, student loans, credit cards, that sort of thing, and a steady job. That person may put 30% of their investment money into large cap domestic, 15% in mid cap, and 15% in small cap domestic, 20% in international positions, 10% in cash or bonds, and 10% in emerging markets or play money. How much of your money goes into each bucket is up to you. If you're younger and can afford to take more risks, you might have more in the small cap bucket or in emerging markets compared to someone closer to retirement age. As you near retirement, you would have less or no money in, say, emerging markets, because by that point you're looking for income and stability more than growth, so you would put more money into the bonds bucket. As I've said before, there are many free online tools that can help you determine an asset mix. I suggest you use one of those tools, or consult a chart such as this one that's included in many 401k brochures, to decide how you want to allocate your investments. You need to decide if you're conservative or aggressive. There's no wrong answer to this question. It's whatever you feel comfortable with. Just keep in mind the general guideline that if you have a long-term horizon and can afford the risk, then an aggressive portfolio could be right for you. If your time horizon is less and a 10% drop in the market could crush you, then a more conservative approach could be the way to go. Whatever helps you sleep at night. Asset allocation is easy and extremely important. I can't emphasize this enough. I read recently that a large percentage of people over 55 lost a big chunk of their life savings and now can't retire on time because they were overloaded with stocks in their retirement account when the market last crashed in 2008. They blame their advisors or their 401k providers or the government or whatever. Unfortunately, those folks can really only blame themselves. They either got greedy or complacent. When you're young, you have a lifetime to make that money back. When you're older, not so much. You must evaluate your portfolio once every 1 or 2 years to make sure your allocations are where you want them to be. If one bucket grows too big, sell some of it and buy whatever bucket has gotten too small. Once you've determined how many buckets you want and how much money you want to put into each bucket, the next question is, what do I buy? Now, unless you're an expert stock picker, and I am not, I highly suggest that you buy mutual funds. A mutual fund is made up of a bunch of stocks, so even though you're buying a fund, you're still buying stocks, but with instant diversification. Some funds specialize in large caps, some in small, etc. So you can fill all your asset allocation buckets with mutual funds. But some funds have loads or high expense ratios. That is not cool. Loads are basically commissions that you pay to the person or company selling the fund. Some loads are paid when you buy the fund, some are paid when you sell. Either way, it's money out of your pocket. The expense ratio of a fund details how much money you'll contribute to the company that runs the fund. These expenses go towards things like the fund manager's salary, or the costs the company incurs to market the fund, print out brochures, things like that. More money out of your pocket. More fees that lower your returns. And there's something else. 80% of managed mutual funds fail to beat the index that they're measured against. So wait, I just told you to buy mutual funds, and now I've said that many of them are loaded with fees or are expensive to own, and about 80% of them don't beat the market. So okay, you caught me. I don't really suggest you buy just mutual funds. What I meant was, I suggest you buy index funds. What is an index and what's an index fund? An index is a collection of stocks that fall into some particular group, large cap domestic stocks, for example. The index doesn't typically care if the company makes pencils or airplanes, is profitable, or is loaded with debt. It's a representation of a group of stocks. An index fund is a fund that consists of all the same stocks that are in that particular index. So an S&P 500 index fund will have shares of 500 stocks, the same 500 stocks that are in the S&P 500 index. Some common examples of indexes you've probably heard of are the S&P 500, the Dow Jones Industrial Average, or Dow for short, the Russell 2000, or the NASDAQ. What's great about index funds is that they typically have extremely low expense ratios and no loads. You're pretty much guaranteed to at least match the market because you're basically buying the market itself. No more worrying about if your fund is one of the 80% that fails to beat its benchmark. What's bad about an index fund is that it's all the stocks in the index. There's nobody there to filter out the bad ones. The index doesn't care if the company's doing gangbusters or if they're losing their shirts. If a company does really badly, it can get dropped from the index, but for the most part, you're getting the good, the bad, and the in-between in an index fund. To make up for that fact, I do suggest you add a managed mutual fund into your mix here and there. Most 401ks have only managed funds anyway. Just make sure you don't buy a fund with loads or high fees. In the Web Tools section, I'll show you how to avoid those. Some examples of index funds are VFINX, which tracks the S&P 500 index, a large cap domestic index, and NAESX, a small cap domestic index. Here's some data on a typical large cap mutual fund. This data came from looking up the fund on the Yahoo Finance website. Notice the expense ratio of about 1.5% and a 12B1 fee of 1%, and then a sales load of 5% on top of that. What the hell? Now here's a typical large cap index fund. Notice the expenses are a lot lower and no fees. If you held both these funds for 10 years, the managed fund would cost about $1,600 in fees, while the index fund costs you a little over $200. The stocks held in each fund are very similar, and looking at the performance of the two, you really don't see that much of a difference. This chart is both of these funds plotted together over a 5-year span. Not much difference at all. So why pay all those fees? It's easy to find index funds and check out their performance and expenses, even compare them to various managed mutual funds like I've shown here. I'll show you all of that in the Web Tools section coming up later. Hey, wake up! What is it with you kids these days and your short attention spans? This is important stuff here. Stop your texting or your sexting or whatever and pay attention for a few more minutes. Index funds may not be very exciting, but you'll be happy with them 20 years from now, let me tell you. All right, let's keep going here.